good morning, everyone, this fine, bright Monday morning. So welcome to your weekly market snippets with me, Geoffrey, educator and market analyst at Scope Markets Kenya. So I hope you all had an amazing weekend. And as we get into this week, welcome to these weekly market snippets. So we're going to start off with what we had last week's market review, what we saw, the various fundamentals that affected the various markets, their trading implications, and now what we expect for the coming week as from starting out from today. So walk with me and stay tuned as we get into this. So starting off last week, we had quite a very fundamental, impact-filled week. Starting off with the JOLTS job openings, we had the ADP non-farm payrolls, we had now the actual non-farm payrolls, then we had the unemployment claims, which is now the initial jobless claims. We also had the FOMC by the Fed. We had the Fed releasing their monetary policy statement last week. We also had the Bank of Canada as well releasing their monetary policy statement. We also had the Bank of Japan releasing their monetary policy statement. We also had earnings for major tech companies like Microsoft. We had Apple as well. So last week was quite a very fundamental week in the markets, and we had a lot of volatility on the various pairs and also on the various stocks that are affected by these various fundamentals. So let me walk you through all this. So starting off with the United States economic updates, that is on the JOLTS job openings report. So the job openings came out at 7.4 million, that is unchanged. The job openings rate was 4.4%. Then the hires was 5.2 million, which is steady. So total separations is 5.1 million. And the quits, people who quitted, was 3.1 million. Then the layoffs or discharges was 1.6 million. So the analysis behind it is that the labor market remains stable with little movement across key metrics. So the quit rate, a leading indicator of worker confidence, remains high, suggesting workers still feel optimistic about job prospects despite broader economic uncertainties. Okay. Then you had the most anticipated non-farm payrolls. We had non-farm payrolls had job creation was plus 73,000. 73,000 jobs were created. Unemployment rate was 4.2%, which was a rise from the previous 4.1%. Then if you look at the revisions, you had in June, it was revised from 147 and upwards of 147,000, so which is an addition of 14,000. Then in May, we had a revised of an additional of 144,000, which is an addition of 19,000. Then combined downward revision was a negative of 258,000. So this led to a very weak dollar that day. So the implications is that this marks the third consecutive month of downward revisions and weakening job creation. So the upward move in the unemployment rate and soft hiring trends could influence the Federal Reserve's monetary stance going forward. So remember, it is the monetary stance that came first. That was on Wednesday evening. Then now the non-farm payrolls came out on Friday. So with this being the third consecutive month of downward revisions and weakening job creation, then definitely the upward move in unemployment and soft hiring trends could influence the Federal Reserve's monetary stance going forward. As we now look at the next FOMC meeting, will this report now give the Fed a stance on now what to expect in the next FOMC meeting? Will we see maybe a potential rate cut? Will we see a potential rate hike? Or will we see the Fed maintain their rates as they did last week? So now, coming into that, I will be giving you that shortly. But before I get into that, let's look at the ADP employment report for July 2025. So the job gains was a positive 104,000. The wage growth was a positive of 4.4% year on year, and a sample base that is 25 million plus, that is in private sector employees. Now, the insight into this is that the ADP's data reflects moderate private sector job creation, outpacing NFP figures, but still indicating a slowdown. So wage growth remains resilient, helping to support household consumptions for now. Okay. Then we do have the initial jobless claims, which is weekly, ending on the week of July 26, 2025. So the weekly claims came out at 218,000, so which is a positive of 1,000. Then you have the 4-week moving average was 221,000. Then insured unemployment rate, that was 1.3%. Continuing claims was 1.946 million, which is unchanged. So the key message is that the labor market strength is softening gradually, but remains historically healthy. However, consistency in unemployment claims could mask deeper weaknesses in full-time job creations. Then you have the advanced GDP for the second quarter 2025, quarter over quarter annualized. So the Q1 growth was negative 0.5%. The Q2 growth was positive 3%. The positive growth drivers were stronger consumer spending and decline in imports, which are subtracted from the GDP. Then the negative is that you had lower business investments, then you had a drop in exports. So conclusion is that a solid rebound in the second quarter, a solid rebound in the second quarter following the Q1 contraction provides much needed momentum through risks, although risks remain given weakening labor data. So we're still having quite a bit of a weakening labor data, and we saw that evidently from the Friday's non-farm payrolls report. Then you had the federal funds rate by the FOMC. This is now the monetary policy statement by the Fed, where they release their rates. So here the interest rates the target rate remains at 4.5%. So it remained unchanged. Now the policy guidance was that it was data dependent approach, ongoing balance sheet reduction, and commitment to full employment and a 2% inflation target. So the Federal Reserve outlook is that the Fed remains cautious, highlighting a balanced risk environment and signaling no urgency to raise or cut rates until more clarity emerges on inflation and growth. Now, remember, President Donald Trump has actually been putting a lot of pressure on the Fed chair, Jerome Powell, to actually cut rates. And he has been putting that pressure on him since he actually stepped into office. But the Fed chair, Jerome Powell, has remained unshaken, has actually made a very bold move in terms of maintaining the rates to gearing the rates towards the U.S. The stability of the U.S. economy, rather than bowing to the pressures of President Donald Trump, which is actually a very bold move to make. So we saw the Fed maintaining their rates at 4.5%, remaining unchanged. So we can only wait until the next FOMC meeting to actually see if will he maintain the rates, or will he have a potential rate cut or a rate hike. Many members of the FOMC committee are looking at a potential rate cut, but it is not yet confirmed yet. The majority of the members of the committee are voting for a potential rate cut, but still it has not yet been confirmed. We can only see that after the next FOMC meeting has happened. So let's be very careful and cautious of that, and see. Let's be on the lookout for that. Then you had the Canadian Economic Review. So the GDP growth month on month. The May GDP had a negative of 0.1%. The April GDP had also a negative of 0.1%. Then the flash estimate for June was a positive 0.1%. But now when you come to the Bank of Canada rate decision that happened last week, they held their rates at 2.75%. The bank rate is at 3%. The deposit rate is 2.7%. So the keynote is that the July monetary policy report refrained from offering a base case, GDP or inflation forecast. Instead, it presented three scenarios. One, the current tariff conditions. Two, the tariff escalation. And three, the tariffs de-escalation. So remember, Canada is one of the countries that was hardest hit by the Trump tariffs, which again were meant to start on the 1st of August. So again, we will get to talk about the effect of the tariffs, also the revised tariffs as well. And the outlook especially for the Canadian economy is that the Bank of Canada remains cautious, signaling that policy flexibility will depend heavily on developments in trade, inflation, and global conditions. Okay. Then coming into the Bank of Japan. So the Bank of Japan has been maintaining their rates at negative for a very, very long time. So this time we've seen the Bank of Japan monetary policy update. The policy rate maintained at 0.5%. The stance is accommodative, and the vote was unanimous. So the interpretation is that the Bank of Japan continues its ultra loose policy, in contrast to Western central banks. aiming to sustain growth amid persistent disinflationary pressures. Okay, and that definitely caused quite a bit of volatility on the Japanese yen and also all the yen pairs. So all pairs that have the yen attached to it, from the the dollar JPY to the euro JPY to the pound JPY, all pairs that do have the JPY definitely had a significant volatility due to this. Then we had the Australian economic snapshot. So that was the GDP as well. So first of all, starting with the CPI, before we get into the GDP. So the CPI, the Consumer Price Index, headline was a positive of 1.9%. The May CPI was a positive of 2.1%. The trimmed CPI, positive of 2.5%, which is now down from 2.7% in May. The top contributors were food and non-alcoholic beverages, so that is a positive of 3.2%. Alcohol and tobacco, that was a positive of 5.7%. Then housing was a positive of 1.6%. So inflation is softening gradually in Australia, keeping the Reserve Bank of Australia on track to maintain or reduce rates if the trend continues. So again, we will be closely observing to see if the Reserve Bank of Australia will either keep maintaining the rates or will end up reducing the rates in their next policy meeting. So something to closely observe as we see how it will affect the Australian dollar and all the pairs associated, all the pairs that are paired to the Australian dollar. Then you have the Trump administration tariffs, which now are supposed to start on the the 1st of August 2025. So the new tariff range comes at 10% to 41% on 30 plus countries. The effective date was 1st of August 2025. So you have notable country rates. I'll start off with some of these countries. You have Syria at 41%. We have Laos and Myanmar, which is at 40%. Switzerland has its tariffs at 39%. South Africa, we have 30%. In Thailand, it was reduced to 19% from 36%. Malaysia reduced to 19% from the previous 24%. Then we have Taiwan lowered to 20% from the previous 32%. Then transshipped goods penalty had an additional 40% tariffs. Then the Canada tariff hike from 25% to 35%. And this excludes USMCA covered goods. Okay, so Canada got quite a bit of hit in the tariffs. So you could even see that's why the Bank of Canada focused on the tariffs escalation, tariffs de-escalation as well, because there's been quite a bit of tariff war between the US and Canada. Okay, so we have the expert commentary. We have ongoing tariff unpredictability is raising alarm among global economists. So former trade negotiators warn of more tariff hikes and strained international relations to come. So remember, these tariffs started off from the 1st of August, which was on Friday last week. Now, as we get into now a new week starting today, will you get to see probably more revised tariffs, or we'll see the implementation of those tariffs and the effect that it will have on the various currencies that will be affected? So these are very key week in the markets. Because we'll be expecting a bit of volatility because of the tariffs on the various countries and the various currencies mentioned. Then the executive order lacks clarity on updated rules of origin, a key issue in transshipment enforcement. So tariffs remain a major source of volatility, threatening to dampen global trade, especially with Canada, Asia, and Europe. Okay. Then the key themes and market implications. So a weak US job growth, the implication for markets is that increased case for Fed rate cuts. So it increases the chances of that happening. Then you have the Canadian GDP flat. So it suggests prolonged rate hold by the Bank of Canada. Then the AUD inflation easing. It opens door for the Reserve Bank of Australia to pause or cut their rates. Then you have the escalation of Trump tariffs. So this threatens global supply chains and demand. Then you have copper, and consumer good prices. So likely to rise due to the new tariff regimes. Remember, copper in the new tariffs. Copper had a 50% tariff on that. Then you had the global central bank divergence. So it brings opportunities in FX, bonds, and equities. So definitely expects quite a bit of volatility into this week in the FX markets. Then last week we also had major tech. We had major tech Last week we had a major tech earnings release. So highlights we have, I'll talk about Microsoft and Amazon and Apple. So starting off with Microsoft, we do have the revenue. The revenue was at 76.4 billion, and upwards of 18%. That is a positive of 18% year on year. Then you have operating income, that is $34.3 billion, a positive of 23% year on year. Then you have Azure and intelligent cloud revenue, that is $29.9 billion, a positive of 26%. Then productivity and business processes, so that is Microsoft 365, LinkedIn, and Dynamics, which got a positive of 16 to 18%. Then more personal computing, that had $13.5 billion, which is a positive of 9%. Then the earnings per share was $3.65, which is up 22%. Then the capital return, $9.4 billion in dividends or share buybacks for the quarter. Then you have market impact. The market impact, you have Azure growth-led sentiment. Microsoft surpassed a $4 trillion valuation following the report. Following that report, then you have coming into Amazon. Amazon had net sales of $167.7 billion, which is an upwards of 13% year on year, excluding a $1.5 billion forex benefit. Okay. Then you have the AWS revenue. We had $30.9 billion, which is a positive of 17.5% year on year. Then we had the operating income at $19.2 billion versus the previous year, which had $14.7 billion. Then the net income was $18.2 billion. The earnings per share is $1.68 versus the $1.26 year on year. Then forward guidance, the Q3 sales forecast. Q3 sales forecast, that is now the third quarter, sales forecast is at $174 billion to $179.5 billion. Operating income projected at $15.5 billion to about $20.5 billion. That is projected. Okay. Then investor reaction. So the shares fell 7 to 8% post earnings due to AWS slowing relative to Microsoft and Google, and tempered guidance. Okay. Then you have the next one was Apple. So Apple released also their earnings last week, and the earnings are as follows. We had the revenue at $94 billion, so a positive of 10% year on year versus the previously expected $89 billion. Then you have the earnings per share, $1.57, which is a positive of 12% year on year. Then the product highlights, we had iPhone, which is at $44.58 billion, which is a positive of 13%. Then you had the services, a record of $27.42 billion, a positive of 13%. We have Mac, a positive of 15%. iPad down a negative 18%. So the competitive context, AI innovation backing remains cautious. So Apple faces tariff-related costs, which is about $800 million this quarter, and $1.1 billion expected next quarter. So again, that is projected. Then the strategic distribution. Tim Cook emphasized renewed AI investment including upgrade to Siri by 2026, and disclose $500 billion in future US investment. So for anyone probably investing into that, that is something to closely observe from the earnings report last week. Now, looking at what we are expecting into the coming week as from today, we will be looking at August 5th. From tomorrow, we'll be having the Reserve Bank of Australia policy meeting. Then you have on August 7th, we'll be having the US ISM services PMIs. Then on August 9th, we'll be having the Canadian employment data. Then on August 15th, we'll be having the US CPI report for July. Then on 27th of August, we will be having the Jackson Hole Symposium, which is usually for the central bankers. So this week's developments signal a critical turning point for policymakers globally. The interplay between labor market softness, inflation moderation, and rising protectionism will shape financial markets behavior in the coming weeks. So we will be looking at those are the key things that we will be looking out for. So expect quite a bit of volatility due to now the tariffs, and we had the non-farm report that happened last week. So this week will be a spillover of what you saw happening from Friday. So be very cautious and on the lookout on how you trade, how you approach these markets this week. And as we start off this week, I wish you all a very, very, very productive week ahead. So let's be fresh, let's be very productive, and let's have a very amazing week ahead. So this week we'll be as from this month we will be starting the FX Mastery Series events here at our offices in Westlands at Westside Towers on the 4th floor. Starting this Friday, we'll be having the series of FX Mastery classes that will be starting off from this Friday. I'm looking forward to seeing you there. Come one, come all, and I'm looking forward to seeing you there for a very productive, enlightening, and informative sessions that will be coming up. So with that, guys, have an amazing start of the week ahead. Let's start the week energetic, very fresh and productive. And I wish you all a very, very productive week ahead. Thank you, and see you on the next one.